Hi, this is Dr. John Rogers, and welcome to this week's edition of the Financial Independence Podcast. In last week's podcast, I gave you some tips about how to negotiate with a loans officer at your bank to get the mortgage that best fits your budget. In this podcast, I will tell you about some of the other things that will not only influence the terms of your mortgage, but also whether or not the bank will actually give you a mortgage. In this regard, you should know that after you've met with the loans officer, he then passes your file on to the bank's underwriting team, who are the ones who make the final decision on your mortgage. Whilst the loans officer wears two hats, one that serves the bank's best interest and the other that serves his personal interest, which is related to his annual bonus based on the number of loans he processes each year that are approved by the bank. The faceless individuals who work in the underwriting department only wear bank hats, and thus will make decisions that are totally based on the bank's best interest. The bottom line for the bank underwriters is that they will only allow the bank to lend you money if they think you will have enough money to pay them back each month for the duration of the loan. To this end, whether or not the bank lends you money will depend on three things: your credit rating, your personal financial balance sheet, and prevailing economic conditions. The first thing that the loans officer looks at is your credit score. In the US, this is called the FICO score. The FICO score determines your eligibility to get the loan and the interest rate on that loan. The FICO score is a numerical measure of a person's financial history and indicates a person's credit risk. That is, the risk or probability that a person might default on his or her loan. Scores typically range from 100 to 850. The higher the score, the higher the credit rating. All credit models are based on 5 categories: payment history, amount owed relative to credit limits, the length of credit history, the frequency of new credit used, and the type of new credit. When it comes to payment history, the banks look at 4 things: late payments, how late the late payments are, the recency of the last delinquent payment, and the total amount owed on your credit card. The second thing is the amount owed on the credit as it relates to your credit limit. For example, let's say you have 3 credit cards, each with a $10,000 limit. That is a total credit limit of $30,000. If you use $10,000 of the total credit, that's okay, as it will not negatively impact your credit rating. However, on the other hand, if you use $10,000 on one card, e.g., you max it out, that's bad because it would negatively impact your credit rating. The third thing is the length of credit history. That is, the average length of time that you've had your card. The longer the history you have of paying your card on time, the better your credit rating. The fourth thing is the frequency of new credit cards. This is an important consideration because if you have a lot of newly issued credit in your credit history, e.g., new loans or credit cards, then lenders become concerned that you may not be able to repay all of this money, and thus they'll be less inclined to lend you money. And lastly, the type of credit. Lenders like to see that you can handle different types of credit. Someone who has only one card will not get as good a credit rating as someone who has a credit card, a mortgage, and a student loan. The loans officer will also want to see your financial statement. Specifically, they're looking for 3 things. The first is the appearance of unusually large deposits in your account. The reason for this is that individuals involved in illicit activities like drug trafficking, illegal immigration, or human trafficking will often use other people called mules to launder their dirty money by paying the mules to deposit dirty money into their personal accounts. As a matter of interest, banks red flag any amount in excess of $10,000. So it's always advisable not to deposit more than $9,900 into your personal account at any point in time, as you may be tagged as a mule. Secondly, loans officers get concerned when they see money going out of the account, especially if it is being used to cover undeclared loans that would not have shown up on your credit report. The third thing the loans officer will look at is your debt-to-income ratio. Generally speaking, most banks require a debt-to-income ratio of 43% or less. This means that not more than 43% of your gross monthly income should be going towards your overall monthly debts, including the new mortgage payment. The fourth thing is how often your account goes into overdraft. Once is okay, but every month would be bad. Finally, the bank underwriters will look at the U.S. Treasury yield curve that I discussed in the last podcast. If the yield curve is upward sloping, which indicates the economy is going well, then the underwriters will be more inclined to offer you a mortgage. But on the other hand, if the yield curve is flattening or inverted, then this implies the economy will be slowing down. Then in this case, the underwriters will be less inclined to give you a loan, or if they do, it will be at a higher rate of interest than you might want. Once the underwriters have received and reviewed your credit score, financial statements, and completed their yield curve analysis, they'll make a final determination as to whether or not you get the mortgage. Now you know exactly what factors banks take into account when considering whether or not to give you a loan. And if you combine this with last week's podcast, then you should be able to negotiate the best deal possible on your next mortgage. So thanks for watching this podcast.